could fix things. I specifically never said that. Life's a mixed bag, no matter who you are. Look at Jesus. He was the Son of God, for God's sake. Look how that turned out.
I know.
Welcome to The Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is August 19th, 2022. S&P 500 currently sitting at 4241. I'm David Zarley. I'm here with Ian RCA McMillan. It's great to be back with you, Ian. I know we've had vacations, we've had some time off, but here we sit, you and me. Let's talk markets. Where do you want to start?
Yeah, I feel like this is only our second podcast together in the last couple months, just because with varying schedules and everything.
Yeah, and that's good. It means time
good.
off with family.
I'd rather take time off in a bear market than a bull market, I guess.
Yeah, that's fair. That's fair. But is it really time off when it's just a rip-roaring bull market? You just kind of sit there and it just goes.
That's true. If you get to 2017. 2017 would have been a good year to take a lot of vacations.
2017 was low vol, as straight a line as you can get. And the late great John Borman would say something along the lines of like, don't complain, just enjoy it.
Yeah. No, definitely. That's a year after looking back on the last 2 years, your 2017s I will never take it for granted again.
Right. Well, and things have changed. The regime has changed. Market regime has changed since the Volmageddon back in January 2018. And I think that's part of painting the big picture. Like the market has its own characteristics, and since January 2018, those characteristics have changed. And we like to think of things a little more not we, but in general, people are very near-term oriented. And so here we have a market that's above 4180. And when I say the market, I'm using the S&P 500. That doesn't mean it's the whole market. But here we are above an important level. Yet it's a mixed bag. It's not like an all clear signal that we're above 4180.
It is a mixed bag.
Right.
Like you said, 4180, big level. Don't think anyone can deny that. It's had a lot of behavioral touches over the last year plus. I mean, we go back to April of last year, which is when, right, a little bit before that is when your average stock began to roll over.
Yeah,
we've same time frame.
Yeah, your average stock has been in a bear market since February and March of 2021. Here we are, August of 2022. You've got the S&P above that 4180 level, but that's a level, as you mentioned, that goes back to early 2021.
It's a big level. Now we've got some, the 200-day overhead. The S&P got there.
Hold on. 200-day
moving average.
Yeah, 200-day moving average. That's looking at the past 200 days of information, averaging it out.
And it's a well-followed, trend indicator, if you want to call it an indicator, a trend tool.
Yeah, it's a characteristic of the market.
It's well followed, but I do think, 200-day moving average gives you a pretty good idea what's going on with, quote unquote, the stock market. And like I said, so S&P gets there, it gets rejected. Russell 2000 actually got above, failed, and NASDAQ has yet to get there. If this was to be we would look back and say,
right, and the reason why
never got there.
Yeah, and I think that's important that you're highlighting those things, because the reason why I say mixed bag is all of the things that you just mentioned: S&P 500, NASDAQ 100, small caps using Russell 2000, all have downward sloping 200-day moving averages.
Mm-hmm.
And at the same time, from a pure price absolute level, we've reclaimed prior highs, but we haven't subsequently locked in a higher low So you have a mixed bag happening underneath a falling 200-day moving average. So there's many ways to define trend. One of them being a moving average, such as the 200-day that you're talking about. Another one being just higher highs and higher lows would be an uptrend. A downtrend would be lower highs and lower lows, which we had going into, let's call it mid-June.
Mm-hmm.
And we've since recorded a near term. So weeks
Been a
to
strong
months.
rally. I mean, it has been a strong 2-month rally.
It has. And what's interesting is seasonality wise, when we look at midterm election years, that's kind of what we've seen is this mid-June to mid-August period is strong. And that's that's what we've seen. So whether that holds though.
And okay, so then what's next? So we've reached mid-June to mid-August, strong, given kind of the context of where we're at, midterm years, Democratic president, right? This is data we've been talking about a lot on the podcast over the last few months. So what does that tell us it's next, though?
Right.
Is any of this lining up?
Right. So seasonality would tell us the period from now through about end of October, early November is weak. And so do we get to be surprised if the market below a falling 200-day moving average is weak? I don't think we get to be surprised by that. But you have to be open. You have to be open for all theses. I know that you shared a great, what I would call an analog chart comparing 2022, the current price behavior versus 2007, 2008.
And there's been some good analogs in general out there. You can do the 2022 to 2028. Nautilus Research had a good one comparing now to 1973, also a bear market, similar visually. And there's some things on the, I guess if you want to call them bullish, the 62 bottom, the 2016 consolidation. There's some similarities there. But the 2008 to 2022 one, I think is oddly specific.
Right. And in the words of Will Ferrell, it gets people fired up.
It does. It does. And that's not to say I don't, this is, if 2002 ends up behaving the same as 2008 in regards to the stock market, right?
Right.
And we're just talking about how stocks behave and not saying, if we're not saying, oh, the stock market in 2022 could follow a very similar path as the stock market in 2028. We're not saying that the economy does the same thing. Maybe it does. I have no idea. But that's not for us to necessarily pontificate on.
No. And markets are a future discounting mechanism. Like we've talked about in the past when we started seeing the market to correct, would there be a negative GDP number? The market's already operating in the fashion of discounting future events. That's how markets work. Is it's looking 6 to 12 months in the future and discounting that what the possibilities are. And like Ian's saying, how would we possibly know whether the third quarter of 2022 is also records a negative GDP? I have no idea, because here's the honest truth. It could be positive and they revise it to negative 12 months later than that in 2023. And that's why we use price, because in the end, government statistics get revised. Price is now. You don't get paid when you execute a trade. You don't get paid in GDP. You don't get paid in future EPS. You don't get paid in revised earnings. It's the price today. And the price that we're seeing today is below a falling 200-day moving average, at the same time above important levels from, let's call it March. The lows in March were above that. That's positive. We're below a falling 200-day moving average. That's negative.
Yeah.
It's a mixed environment.
It's a very mixed environment. I think you see that also in the individual name space. I mean, you've had some areas that have obviously been gangbusters.
Yeah,
walk me through this potential bottoming process.
Yeah, walk me through that. Like, where are we seeing strength? Where are we seeing weakness. Some would call it winners, some would call it losers. Like where in this, if I may, from the lows in June, where's the strength and where's the weakness?
Well, I think for me, I start with energy from a technical perspective once, because they were the strongest during a majority of this. So even with their sell-off, I mean, from a technical perspective, they still look the strongest.
Well, even like a date like today, this is August 19th, 2022. You have the S&P down about 1%, but here you have energy up about 0.5%. That's information.
Things that have been working, not in equities, but carbon credits have been working. Natural gas, right? Natural gas and crude they've kind of diverged from each other, I would say. Crude,
I think
as long
that's a
as
fair way to say
crude's
it.
below 94, I don't think there's too much to worry about. I don't know if $5 gas is coming back as long as crude's below 94. Net gas, on the other hand, definitely pushing for new highs. And you've seen areas that led initially, like biotech in China, have been real weak the last couple of weeks.
Well, no, for sure. And what's interesting is if you look at oil futures versus natural gas futures, depending on how you look at it, there's a fresh relationship change happening that goes back in time pretty far. And what I mean by that is you take one and divide it by the other. So you take the oil futures divided by natural gas futures, and it's definitely, to your point, if we're talking about energy, it's towards natural gas.
Yeah, for sure. I mean, you can see a big move lower. Okay, let's take out 2020 and whatever happened there with negative oil and all that.
Right.
We can put our thumb over that. But yeah, I totally agree. Breakdown below this, let's call it on a ratio level 10, 5.
Yeah, exactly.
10.5, and there's definitely a chance you could see natural gas outperform crude by,
that's a legit,
I don't know,
70,
80% over the next few years. I mean, now, right, this is not happening. We're talking about a multi-year development here.
Correct.
We go back to the lows.
This isn't weeks to months. We're talking about a long-term, like minimum 50% change in this relationship between natural gas and oil. And that's huge. I mean, and that has ramifications. So if you're going to be allocating towards strength in a portfolio and you're owning energy, well, based on this information, your natural gas companies probably should get some more credence over those things
do work themselves into the process. Like, you find yourself buying those types of stocks without even looking at this relationship.
Right. They're showing themselves. What Ian is saying is, yes, there's oil for futures versus natural gas futures. You do that comparison, and there's a clear line in the sand. But you also look at the companies and the stocks that are related to them that deal in these things, the ones that pull the liquid energy out, those who pull the gas energy out. There's a difference. And that's why we use charts.
And they show up, right? Like, you see that in the process. You see LNG names pop up over companies that are more specifically geared towards crude.
Right. And this is happening in an environment with dollar strength.
Dollar, okay, let's touch on that. That thing, we're back to 108.
Yep.
Then we still have not come back to really testing the 104. I guess we got back to 104.
And I'm going to talk a little shop here.
About 5, but
yeah, right. When you have a quote unquote retest, if it retests the breakout level, and what Ian's alluding to is the breakout levels around 103, 104. We never got back to that. if we never get back to that, I shouldn't say never. If we in the
Not
months,
yet. We haven't.
months and years to come that we don't get back to that, that is definitive of how much strength is there. So you don't even come back to the breakout level. That's how much strength is in the dollar. And yet you've got energy names continue to hold up well. You've got energy, it's like your liquid and your gas energy holding up well in a dollar strong environment. That, how is that not information? How is that not something we pay attention to?
Dollar, as long as it continues to hold, this 50-day moving average, it's a number that sounds insane. 104 sounded insane to a lot of people when we first said it was probably going to get, or it had a good chance of getting there back in, a year ago. When
but are we going to,
dollar sitting at 93, we said there's a good chance it goes to 94 or 104. Then we get above 104. We come on the podcast. Yeah. And we say there's a good chance. There's nothing in the way of this until 120. And again, we see this happening over months. Could you get there by the end of this year? Maybe. At this rate, you would be there by next summer.
I was going to say, I'm guessing in 2023, there's some narrative about the strong dollar.
Yeah.
Which is too late.
Probably going to throw a monkey wrench in this trend.
And it's too late.
Once everyone catches on, once Barron's puts out their cover article,
right,
it'll probably be over.
We will say it a million times. Price moves first, news moves second. So your narrative comes after price. And the fact that we could be at 118 to 120 in a dollar, a trade weighted dollar, something using DXY in the next 12 months, that is not, it's beyond a non-zero. It's a likely scenario as long as we're above 103. Below 103 in a trade weighted dollar, that thesis is dead. Above that.
Well, and then, you've got the euro, right? The euro breaking and retesting a massive support at that
well, the euro's
$1 parity level.
Well, and the euro's going out. Trade weighted euro is going out a new relative, a new absolute low. It is the euro. I know you talked about this a couple of podcasts ago, but you're taking your significant other over to Europe. It might even be better as we go along here. It's just on a relative basis, the trade weighted euro versus the trade weighted dollar continues to break down, definitely in a downtrend. And that has ramifications across all other asset classes.
Isn't next year the 50th anniversary CMT symposium? I don't know why we wouldn't be doing it in Europe at half the cost.
That's fair.
Tyler, if you're listening.
Tyler would. Maybe we should be doing this,
London, Paris.
London, or Prague.
Yeah.
Is that too much
cheaper than Brooklyn?
Is that too much to ask?
Or Manhattan?
Tyler? One Viking fan to another. Let's get this done. So you have this dynamic of currency, meaning most people associate stronger dollar that's going to hurt energy commodities. That's not the case. But let's talk about commodities that are hurting in this environment. Because, this is supposed to be inflation or peak inflation, whatever the topic du jour is. We're not seeing the same out of gold and silver.
No. God. Miserable. Continue to just gold again. Gold miners again today. Juniors down 3%.
It pays to pay attention to the charts that are in front of you. You have things like oil and natural oil testing important levels, natural gas almost going out to new highs, strong dollar. You're not seeing the same thing out of the raw gold, raw silver, and even the companies that mine those things not doing so well.
Bitcoin, cryptos also. Well, Ethereum's been better than Bitcoin, but if we want to use this as our two big.
Well, and really, and I always get not nervous. I want to be careful that when we look at cryptos overall, there's a bajillion of them. I'm not even sure if bajillion's an actual term, but you get my point. If you're listening, that's a lot. There's a lot of cryptos, there's a lot of tokens, etc. when we look across that spectrum, there's not a lot of things that look well. And it's really just Bitcoin and Ethereum, in my personal opinion, when I look across crypto, that look okay. And I'm not saying
I don't
okay.
want to buy Bitcoin. Probably don't want to go buy. If I don't want to buy Bitcoin, I probably don't want to go buy anything else.
Correct. Like those are the ones that it's almost like they're the last ones clinging to the cliff. And that's not a projection. That's not or a prediction, but the rebound in Bitcoin from mid-June, pretty anemic. And same with Ethereum, but Ethereum being better than Bitcoin. But when you look at everything else, when you look at a lot of the crypto space, there's not a lot to like there.
No.
And these are the last two. And these are the ones people know. They're the name brands, if you will. These are, there's not, I'm struggling because I know that there's listeners that would understand what Uniswap is, or they would understand,
or Mana.
Right. Like some of these, but there's also some that we're like, what are you talking about?
We're talking about big picture, your Bitcoins, your Ethereums. Those are, two pretty practical cryptos you can watch to gauge the overall health of the crypto market. And
we're not, Polygon. Like, so there's one part of our listenership that's very versed on what cryptos there are, and there's another listenership that's not. And I don't mean that as a mean thing. I just mean the things that have held up, the crypto that has held up during this period from mid-June is Bitcoin and Ethereum. Everything else doesn't look as great. And if we see Bitcoin and Ethereum fail here, that's pretty big information. That'd be similar to saying we're seeing Apple and Microsoft fall off.
Mm-hmm.
And maybe that's a good segue, because Apple's been a Goliath, man. Like, Apple has been super resilient through this period of correction that, if we were just using the S&P 500, that we would say, was started in December and January of this year. It's been resilient. It's gone out to new relative highs, but we're starting to see some weakness there.
For sure.
So whether it's Apple, Microsoft, even
will it finally roll over?
I think of Google. I'm going to use ticker GOOGL as my guide here, because there's two, right? There's two issuances.
Fail breakout. You saying this fail breakout here at 118, 119-ish?
Right. That was a nice looking base.
It was
of a potential accumulation. Now, again, hadn't reclaimed prior lows at the 125, 126 level and something like GOOGL. People need to understand, like, I'm not talking about some small stock. I'm talking about Google.
Mm-hmm.
This is an important market contributor, plus or minus, that equals about 4% of the S&P 500. That's a pretty big chunk, by the way. But below on GOOGL, below 118, 119, it's a little problematic.
Yeah, I don't think there's anyone reason to be involved in or especially understanding the fact markets are still in a downtrend. It's been an awesome last month. Markets are still not out of the woods.
No.
So when you see action like that, I think you give it a lot less time. Whereas if we were in a healthy uptrend, I definitely think you could give it a day to fix itself, but not here, not now.
Right. And so the big names, and what I mean by that is your Apples, your Microsofts, your Googles, Amazon, Tesla. Some of these have broken what were positive developments. So for example, Tesla. I understand how much people love it, but below 927, 928, it's a flat 200-day moving average on this stock. It's a hot mess. And if we can't reclaim those levels.
It's another one that's failed at its 200 day. Well, I guess we've had a couple attempts here. Looks like we'll fail again today. Yeah.
And Amazon definitely is reacting to its falling 200-day moving average.
It is.
And Apple, you could make the argument that this rebound in the US market, and
Microsoft reacted at rejected right off its 200 day.
Right. So we haven't even touched on international stocks at this point.
Let's not bother. They're horrible.
They are. And
They're
and
leading
we'll-
us. I mean, they're leading on a relative basis. They're leading us slower.
absolute trash, like burning garbage. And this is why you don't use modern portfolio theory and portfolio construction, that you have to own international, because it's terrible. And where I was going with this is, when you look at what stocks, who is helping to the upside, right? Because we want to look at relative strength. We want to look at those characteristics. Apple has been in a straight line since mid-June to its almost prior highs, but nothing else is
trend.
nothing else is doing that. And my
I
argument,
want to talk about, like, I hate to use this word, but that looks pretty controlled to me.
it does, and that's fine.
That's fine. I mean, it is what it is.
It is what it is. I mean, controlled is a great way to say it. And my point being, Apple has carried the water on this. We have seen breadth expansion. I'm not going to argue that. I'm not going to argue that. But are we talking about the type of breadth expansion that you see in a new bull market? Maybe.
See, now, and I think that's where a lot of that's what makes it tough, is I will say the breadth that we've seen over the last few weeks has been pretty darn strong. Definitely better than the breadth we saw in 08 at this, like, right? If we want to pull them analogs up against each other, and I did that. You can go on Twitter and look at it. Breadth much better this time around. And I had seen some stats where, I mean, there's definitely, if the market were to roll back over and we continue this downward trend for the coming months, this definitely would have been one of the strongest breadth thrusts to ever occur in a bear market.
Oh, okay. So are we looking, what's our time frame here? Are we looking, obviously we're looking at the 2000s bear market, the 08, 09 bear market. Do we have that information on any of the 70s bear markets? And the only reason why I ask this is, we know that breadth thrusts happen in bear markets, but you're saying this is one of the strongest ever.
So this is some data from Milton W. Berg. It's a CFA. Not that that means anything. He's a CFA who practices technical analysis, so good for him.
Just make the conversion, man.
So if this were a bear market rally, this would be the rally, or if this is a bear market rally, the S&P gain of 17.2% would be the greatest bear market rally after an interterm bear market. So he's got some specifics in here. Okay, I'm not going to sit here and read it all out, but he's got some really good data points. You can go find him. It's at Berg Milton on Twitter. It's a thread from August 16th, so 3 days ago. And he does talk about a lot of the breadth we've seen, the things, you know, the 40-to-1 advanced decline generation. That would be the first time it's ever happened. We had a 50-to-1 advanced decline that was generated during this last rally. That would obviously also be the first time that would have ever happened in a bear market. So either we are done. I'm not saying like we somehow go back to the low, like the worst is over, or this was the greatest bread thrust and going to be ensuing rug pull that you've ever seen in a bear. That's the way I take it.
Got it. I get it. And then part of me wonders, when you look at the mechanics of everything, when you've got a volatility index above 20, how is that not like, so
the VIX? I mean, the VIX is in an uptrend for over a year.
And I think I would compare what you're saying is, here's the bull thesis, the higher price thesis. And Ryan Dietrich's work also supports that, right? Reclaiming, having a bear market and eclipsing the 50% reclamation or the retracement of that. We typically don't look back.
I did see that was good. Yeah.
And so maybe we don't. Maybe this is it. And we see Apple go out to new highs. We see Microsoft go out to new highs. We see Google go out to new highs. And my only pause is like when you see equity performance in its response to stronger dollar, I mean, something's got to give. Like we're either seeing dollar below 103 and equities rip, or we're not. And so it's gonna be fascinating to watch. And that's why
I've got a question. Okay, how much? So would you? This is if let's say this turns into a bear market. This would be the first. I know, like an actual. Okay, this like an actual multi-year recession bull market.
Wait,
Not like
multi-year recession bear market?
Yeah,
Is that what
let's say
okay.
that's what we're going. That's how you said. Let's say that's what's already started.
Okay.
Not just like some 20% drawdown like we saw in Q4 2018 or some other like 20% drawdown, but it's really a sideways move. But I'm talking like 40 to 50, 60% drawdown on major indices. And so what? We're only like a third of the way through that.
Mm-hmm.
This would be the first, what I would call bear market recession in the age of social media.
Oh, okay. That's fair because that's absolutely fair.
I mean, Twitter was around in 07, but like FinTwit, like
no. Yeah.
The knowledge that is shared and generated
100%.
is so like the thing, like you talk about Dietrich and we talk about all these, Dietrich and the stats he shares, or you can talk about the similarities between 2008 and 2002 and like, oh, but is it going to pan out because there's too many eyeballs, right? Like that's kind of a bigger thesis. Like this is the first time that we're all going to go through this where so much of this data and insight is like publicly shared and argued over. Like this is the type of stuff that, I mean, portfolio managers and like this is the data that they had behind closed doors for years and things like that. These little data points. Like, oh, if we get, we get this type of thrust, or at least people had them on their own. But now it is shared so publicly. Everyone has their own version of what a thrust is. 30-day highs, 40-day highs, 41-day highs, 42-day highs, like whatever, however you want to like, there's so many ways to look at it. And it's the first time, like, right, we went through this as in a bull market together for the last 10 years, you could say. I mean, when did FinTwit start really getting big? Like 2011-ish, 2012-ish, maybe?
Right.
But now it is just this echo chamber. And like, you can choose your echo chamber. It is a pick your own adventure world out there on FinTwit. You want to be bullish? You can curate your feed to be bullish as hell. Pardon my French. You want to be bearish? You can curate your feed to be whatever you want it to be. And there's amazing data on both like sides of it.
No, absolutely.
I just think it's like going through, I just wonder like the data, it's so like, does it get diluted? Is the fact that there's so many insights on everything that happens? Like, is that good? Is that bad? Does it dilute it or does it exponentialize it? I don't know.
Well, I don't think we have an answer, but I do know that
I certainly don't.
What hasn't changed is there's institutions that are managing billions, trillions, and there's retail that's not. And when we think about tops, market tops, they typically are not V tops. Now, exception being like if you look back at like the dot-com bust and tech stocks, that was definitely blow off top behavior, V top type behavior, but and there were message boards.
I mean, yeah.
And there are message boards, but not to the degree now where you have Twitter, Reddit.
And it's good stuff, dude. I mean, this is like people who manage billions sharing their, I'm not saying that everyone, maybe gets on, but like there's a lot of. I mean, I would say institutional side's pretty involved in FinTwit. We're involved in FinTwit.
Oh, no, for sure. There's definitely more. And I think you're alluding to this, like free knowledge.
Yeah. It's just free good. I mean, some of it, a lot of it sucks. A lot of the input sucks. But I think it's more like the free data availability, or not even free, but the free, I act like you can pay how much to Koifin now. Whereas, dude, you weren't paying $20. Well, I don't even know how much we pay for Koifin, whatever it is. But you weren't paying that 10, 15 years ago. Like that's the type of data that institutions paid $40,000 a year for because it came on a Bloomberg terminal.
Oh yeah, there's way more power in the hands of retail, but I would also make the argument that there's way more power in the hands of institutions as well.
Yeah. Because they have
Right.
the data on retail.
Correct. They have order flow. They have computing power on ratios and pair trades that most don't. They can see who's in a trade, who's not in a trade. And this is the arena, man. Like, this is the most competitive environment on the planet. I love football. I love baseball. I love all the sports. But this
It's the hardest. It's the hardest
This-
thing to do.
this market, being in markets,
Yeah.
is the arena.
Even in at 2017, like there were things to like you have a 2017. It's so abnormal. It's so abnormal that you're actually looking over your shoulder. Like, yes, you can talk about sit there and enjoy the trend. Obviously, you're a trend follower, but it's so abnormal that you're still wondering, is there something common?
Well, and I know one of the,
And that makes it hard.
one of the sub headlines from this week would be Bed Bath and Beyond and meme stocks and who got involved and Cohen not and dropping out of his stock. Like, you're talking about Reddit retail versus billionaire manager.
Yeah.
And billionaire manager, I don't mean this in any type of mean way, wins on the trade.
Yeah, he does. I mean, the sucker these people over in what? I mean, I guess it's a podcast, maybe for another day. But I mean, it was classic. I got a text about it. What do you think about BBBY? I was like, don't touch it.
But
Less than 24 hours later.
Going back to your original thought processes, never before have we had this type of information available at a retail level for investors.
Yeah. And either it's your ability to go and garner it yourself or just the sharing of it.
Well, and this goes back to, there's a couple different, like a 21st century, being able to aggregate and filter out your own content is super important.
For sure.
And at the same time, people should not sit there and think that they have an edge. Like, even institutions spend millions and billions, and they may have an edge, but they don't have an edge.
Or they may have an edge for a bit.
And
or it's an edge that comes and goes. I mean, depending on what volatility is doing, right? Because I mean, there's things that work when VIX is above 20, and there's things that don't work when VIX is below 20.
Exactly. And so the idea that there is some grand manipulator, if you're listening to this and you think there's a manipulator, be careful.
Or is it that like arbitrage, like so many edges are quickly arbitraged, even if it's naturally, not even if it's someone like it's just because things like entropy, it happens quicker. Cycles happen quicker. Everything happens quicker. Like reversions to the mean happen quicker. Edges are sought out and, defeated quicker. Right. Because an edge is, some type of, I could define it as some type of irregularity in the market, like some type of, and is it quicker naturally for that just to be sought out and destroyed now?
Well, and here's the deal. Markets are humble pie making machine. Like, that's what they do. It's a discounting mechanism. Very rarely does someone gain an edge for an extended period of time. And that's why price is so important, because in the end, if you have a thesis, it can only be confirmed or denied by price. Like, it's not like you have an edge because you have a macro view that's different than everybody else. In the end, your macro view could be different than everybody else and absolutely suck.
Yeah.
Because the price doesn't confirm it. So what does macro view even mean if it's not confirmed or denied by price? And that drives some people nuts, that their opinion could be subject, meaning under the kingdom of price. That drives people wild, that their opinion could be less than the opinions of the masses. This is life, people. Like, I don't know what to tell you, because the S&P, if it's above its 200-day moving average, that's a different thesis than below its 200-day moving
and I
average.
think that's And so if you go back here, your risk reward, Scott Brown had a good tweet on this morning. Your risk reward as we sit right here at 1:41 Eastern time, August 19th, is to the it's to the downside, I think.
Oh, yeah. You're just saying that we have a downward sloping 200-day moving average on the S&P 500. This is a huge behavioral level, this 4,300. So we talked about 4,180. We reclaimed that. But 4,300, this is, so October 21. That's when the S&P moved higher, when many things were actually accelerating downwards. So we've had a correction in the average stock since February 2021. But in October is when the S&P literally went the opposite direction in most stocks.
Yeah.
And so you had this higher highs being made at the end of 2021.
And it looked good.
It looked good. But this is a huge behavior level that if we close below 4,300.
So would you say that, so there's a big chunk we can talk about based on what you're saying. Let me see if you agree with this. February, March 2021, we see a massive portion of publicly traded stocks fall off, start trending side. Most of those small caps, right?
Sideways or down. Yep.
Sideways or down. And then
the average retail account from July of 2021 through July of 2022 down 34%.
And so would you say, yeah. And would you say then again in October, another slew of mid and large cap stocks also diverged?
Yeah.
Kind of like another tranche.
Yes.
6 months later was like, all right, because it was a lot of these software, these small cap growth and small cap in general, right? You can go look at Russell 2000 and there's a very clear difference in what it did versus the S&P and the NASDAQ starting.
Well, and just look at some of the big names. Okay. And I'm going to try to make this analogy, and I want to be very careful because I have a very strong heart towards those people who serve our country. But you have your infantry, you've got your lieutenants, and you've got your generals.
Mm-hmm.
From February of 2021, you had your infantry fall off.
Yes.
In October 2021, you start to see your lieutenants drop off. And here's an example. JP Morgan.
Yeah.
One of the biggest financial stocks in the world. October, November 2021, those are the highs.
Yep.
And
you're exactly right. Peaked on basically Halloween.
Right. And that's your second tranche. I think that's the term.
Great example.
That's your second slice. So your final slice are the generals. The generals are the big boys: Apple, Google, Microsoft. Amazon. Like,
that's your fangs. Yeah.
These are your names. And even Amazon, I believe its all-time high on an intraday basis is late November 2021. And so the last generals, it's really coming down to Apple and Microsoft when we look at price data. And I'm talking about broad spectrum, because when we alluded to this before, internationally, things are terrible.
So horrible, especially on a relative basis. I mean, I go through relative highs and lows every night for the last 2 weeks. Every night, the European ETFs have just continued to make up a big chunk of that list. EFA and EEM both going to new relative lows this week.
Yeah, it's not like you're hiding out in international equities. You're just not. But it's these generals have to keep it together.
And I think I would say, Apple, you're not today, you're not risk reward on Apple here is that this goes.
No, I love this. I love that you said risk reward.
Yeah,
what do you mean? What do you mean by that? Why do you say the risk reward on Apple is not great?
Because of the supply that you're already going to run into.
Yeah, like
Apple. So you're already. you've got overhead trend resistance. You've got, horizontal supply here at 178, then again at 180. Like, you're going to try and fight through all this versus look how much energy it is spent getting here. I'm not saying trends can continue. We've all seen insane trends.
Right.
I'm just saying risk to reward. Like, I'd be done with Apple. Like, if you've been long Apple, I guess I can't give advice, but I would be very,
it's very hard pressed.
And then what you're running into on the broad indices. I mean, this is, I think if this is a bear market rally, or even it's not, I mean, I think we could continue building out bases. I mean, maybe Apple needs to come back to maybe it comes back to 156. Okay, so let's say Apple comes back to 156. I don't know what type of retracement that is of this latest rally. It's a 15%. I don't know. It's kind of like close to your 61 point. I mean, 61.8 ish.
Well,
right.
And this gets
that's
back
a 15% decline. What does a 15% decline do for the S&P?
Right. Right. And it goes both ways. Like, okay, if Apple wants to clear 180.
Oh yeah. Well, then
that's game on. Okay. That's fine.
Then your thesis flips.
Yes. And that's how we
you
need
got to
think.
accept that, hey, okay, this is about to get serious.
Right. It's an open mind. We should never marry our opinions. And I've said this before. I married my wife. I don't marry my opinions. If Apple wants to go out at new all-time highs, it's going to be really hard for this bear market to continue.
Yeah. And then you got to assume that's going to take your NASDAQ and your S&P above their 200 days.
Right.
And that'll set off a whole new, new bullish regime in a lot of people's minds. If you're,
and here's the I don't know if irony is the right word, but we could clear the 200-day and go back to, let's call it S&P 500, 4775. That's fine. But you could also have another year unfold of this market going jack nowhere with a flat 200-day moving average.
See, I don't know why you say things like that. I don't know why you put things like that out there in the universe. But yeah, no, it's true. I mean, maybe this is one of the biggest market tops of, it takes, maybe we do need to go through another year of distribution.
Because major market tops typically aren't blow off. They can be, as I highlighted with the 2000 NASDAQ situation. But distribution takes time. If you're trying to divest yourself, if you're trying to be out of Apple, you know how much time that takes? Lots of time.
Yeah.
So it's a mixed bag. It is a mixed bag of environmental market information. And we haven't spent time. We haven't even talked about that market.
Bonds. You had the NASDAQ in 2000, but the S&P in 2000. That was how long did that take to roll over? That didn't start. It started before, right?
Right. Well, and then think about the old guard, Dow Jones.
Oh my god.
That was simply 99 through 01. So 2 years of a hot mess. That was, oh man. And
that's a great point.
We haven't even talked, we've talked equities. We've talked.
That Dow topping pattern was that's disgusting to even look at.
Right. And we haven't even talked about bonds yet.
And look what that does. Look what that Dow does to its 200-day moving average. You're just tortured.
Right.
For 3 years, almost 2 years,
years. And that was while semiconductors and NASDAQ and anything that had a .com name on it flew upwards. And that's fine. That's great. Whatever. I don't sit here and tell you that's right or wrong.
No. Yeah.
But in this currently where we're at right now, the big boys, which I don't think we've ever been this concentrated from an index perspective with Apple and Microsoft. It's a huge amount that they're a huge slice of the pie. And we haven't seen that for a while. And if we're not going to correct unless they do, this thing is done if Apple, and when I say this thing, this current bear market is done if Apple and Microsoft move higher. It's that simple. But if they don't, that's where maybe you start to see some things accelerate. And we haven't talked about bonds. We haven't talked about VIX. We talked a little bit about VIX, but the volatility index still remains elevated going back back to 2020. This 20 level, this 21 level on the CBO VIX, huge level. And if we see this rise higher from here, it's going to be really interesting. And we're seeing bonds cool off again, which means potentially higher rates. And is the energy / value moving higher while growth tech moves lower, while rates move higher? Is that trade back? That was a trade that was here early in the year.
Was. And then I also wonder if industrial metals will make it back into that. We'll see.
Okay.
Copper's a little, it needs to get over 3.75.
Well, and it had a pretty major breakdown below 3.96 on a distribution that goes back to February. Again, there's that month again.
I mean, you could come back to 4 and, that's your neckline and you haven't fixed anything.
Correct. You come back to that and it's like nothing. Yeah. It doesn't fix
another
anything.
10%. Sure, that would be good for stocks, but
so there's a lot of mess out there. Really, when we look at where there's any strength, it's still U.S. There's not a lot of international strength. It's mainly U.S. It's mainly large in the equity sphere. When we look at bonds, right, that risk parity trade, meaning the 60-40 portfolio, some weakness out of bonds this week. Does that continue to confirm the weakness that we saw that started really, back in that early part of this year? And you could say back in December of 2021, where we saw treasuries fail, does that continue, which hurts that quote unquote conservative growth portfolio again? Are we seeing that return to energy, value, higher rates? That's TBD. Or does any downside accelerate with Apple and Microsoft to the downside? I have no idea. That's why we use price. I have no clue. Anything else, Ian? We bumped up to the end of our time. Anything else that we haven't touched base on that we should highlight before we sign off?
No, I think I've ranted enough.
Yeah, we've exhausted a little bit.
I think we've covered it all. Not much more to say. Big picture is market is still in a downtrend. Have we emerged out of into a new bull market? I don't know yet. But the major industries are still in a downtrend. There's still some individual names out there that are acting great. I mean, utilities are just hit new all-time, right? They're the first sector to new all-time highs, right? So you wouldn't see, real capitulation until you saw things like you would think, or you could just see a bear market continue in some areas and, maybe it continues to be a bifurcated market.
Yeah.
The major indices remain in a downtrend.
They do. And I remember several podcasts ago, and it's great to have Pratty back on the team, and maybe he can look this up, but there was a comment in one of our podcasts where we talked about small caps could rally 23 to 25% and not fix anything. And that's exactly where we're at right now. So we have to let price confirm or deny whether we're going to see more appreciation out of small caps or whether we roll back over. Because small caps, pretty critical level. We're seeing financials roll over. We're not necessarily seeing super amount of strength out of things like semiconductors. So it is definitely not out of the woods scenario, even though we've seen the S&P 500 rally from its June lows about 18%. And we're not even close. I mean, we rally 18% and we're not even back. We're not backed up all-time highs. I mean, that's still 10% to go, 11% to go. We'll see. So anyway, great to be back on here with you, Ian. You always bring the greatest. So I appreciate it. The Adaptive team is rolling. I love that. We love everybody that's listening. goes without saying, if you made it to this part of the podcast, please give us high rankings on whatever platform you're using, whether it's Stitcher, Spotify, your favorite Apple app. Like, mark us up, give us that high ranking. We do this for free at the same time, and it's not like doesn't cost us anything. So if you guys could give us a high ranking, we'd appreciate it. Ian, great to be on with you again.
Great to have you back. Have a great weekend, everyone.